What if I told you that what happened to gold today wasn't random? It wasn't just another normal price swing, but a move that could quietly signal what's coming next for the entire financial system? Because while most people were busy with headlines, gold made a move that smart money never ignores. And if you trade, invest, or even just watch the markets, today's price action matters more than you think. Before we break this down step by step, make sure you hit the like button and subscribe to Silver Shockwave right now. It helps this channel reach more serious investors like you, and it tells me you want real-time breakdowns when big moves happen. Now let's get into it. So here's what we saw today. Gold opened with steady momentum, but within the first trading session, volatility picked up fast. Buyers stepped in aggressively near key support levels, and that reaction tells us something important. This wasn't panic selling followed by weakness. This was controlled movement. And when gold moves in a controlled way during uncertain conditions, that's usually institutional positioning. Now let's zoom out for a second. Gold doesn't move in isolation. It reacts to the US dollar, Treasury yields, inflation expectations, and global risk sentiment. Today we saw subtle weakness in the dollar index. Not a collapse, not a crash, but a hesitation. And gold immediately responded. That relationship has been consistent for decades. When the dollar stalls, gold tends to breathe. But here's the part most people miss. The move wasn't just about the dollar. Bond yields showed signs of exhaustion as well. When yields stop rising aggressively, the pressure on gold eases. And today, that pressure eased just enough for buyers to regain control. Think about the psychology here. For weeks, traders have been nervous. Inflation data, Federal Reserve commentary, geopolitical uncertainty, all of it creates noise. But gold thrives in noise. It doesn't need chaos. It just needs uncertainty. And uncertainty is exactly what markets are swimming in right now. Now let's talk technical structure for a moment. Gold respected a major support zone that has held multiple times before. When a level gets tested again and still holds, it becomes stronger. Today's bounce off that zone wasn't dramatic, but it was precise. Precision is what professionals create. Retail traders chase spikes. Institutions build positions quietly. If you look at historical patterns, whenever gold consolidates after a pullback and refuses to break lower, it often sets up a continuation move. We've seen this before during inflation waves, during rate pause cycles, and during geopolitical tension spikes. The pattern isn't perfect, but the probability leans bullish when structure remains intact. Now, let's address the big question. Was today the beginning of a breakout, or just a temporary relief rally? Here's where it gets interesting. Volume increased on the rebound. That matters. Rising price with rising participation is stronger than a weak bounce on low volume. It suggests commitment, and commitment in gold usually means longer-term positioning, not day trading noise. At the same time, options activity shows elevated interest in upside protection. That means traders are hedging against higher prices. People don't hedge against something they don't fear. The market is quietly preparing for potential upside volatility. Another factor we can't ignore is central bank behavior. Over the past few years, central banks have been consistent net buyers of gold. When sovereign institutions accumulate, they don't do it for short-term flips. They do it for currency diversification and long-term stability. That underlying demand creates a floor under the market. Now imagine this scenario. The Federal Reserve signals patience instead of aggressive tightening. The dollar loses momentum, yields stabilize, risk markets wobble slightly. In that environment, gold doesn't need fireworks. It just needs stability to grind higher. And here's something powerful. Gold often moves before headlines confirm the shift. It's a forward-looking asset. When it starts building higher lows quietly, it's sometimes the first warning that macro conditions are about to change. On Silver Shockwave, we always talk about reading the structure before reading the news. Today's structure suggests accumulation rather than distribution. Sellers tried to push it lower. Buyers defended. That battle matters. Let's also talk about inflation psychology. Even if inflation numbers cool slightly, long-term expectations remain sticky. Debt levels globally are high. Governments can't afford extremely high real rates for long periods. That dynamic historically benefits hard assets like gold. And don't forget geopolitical tension. Even when it's not dominating headlines, it sits in the background. Gold acts as insurance. Insurance doesn't spike only when disaster hits. It gets bought quietly before people feel comfortable. Now let's address the bearish argument, because we always need balance. If gold fails to break above recent resistance and starts making lower highs, momentum could fade. Traders watching short-term charts would step back. That's possible. Markets don't move in straight lines. But here's the difference this time. The pullback didn't break long-term structure. It tested it. And that's a huge difference. Testing creates information. Breaking creates damage. Today we saw testing. If you're a short-term trader, you're watching resistance levels closely. If you're a long-term investor, you're watching macro alignment. And right now, macro alignment is not hostile to gold. Let's talk sentiment. Retail sentiment surveys show mixed positioning. That's actually healthy. Extreme bullishness often precedes corrections. Extreme bearishness often precedes rallies. Mixed sentiment means the market isn't overcrowded in one direction, and that's when moves can extend quietly. Now imagine if tomorrow we get slightly weaker economic data, the dollar dips further, gold pushes through resistance. That breakout could trigger algorithmic buying. Once momentum traders join, volatility expands. But even if that doesn't happen immediately, the foundation appears stable. Stable foundations matter more than explosive candles. Another important point, physical demand remains strong in key regions. When physical buyers step in on dips, futures markets tend to follow eventually. Paper markets can lead temporarily, but real demand creates a durability. If you've been watching gold for years, you know it moves in phases: accumulation, expansion, consolidation, correction. And then the cycle repeats. Today felt more like accumulation than exhaustion. Let's bring this down to practical thinking. If you're holding gold, today likely reinforced confidence rather than created fear. If you're waiting for entry, you're probably watching for confirmation above resistance. If you're skeptical, you're waiting for failure. That tension between buyers and sellers is exactly what creates opportunity. And here's something powerful about gold compared to other assets. It doesn't rely on earnings. It doesn't rely on innovation cycles. It relies on trust. And when trust in monetary policy wobbles even slightly, gold benefits. We're also entering a period where political uncertainty tends to rise. Election cycles, fiscal negotiations, budget debates, all of these add background pressure to currency stability. Gold doesn't need chaos, it just needs doubt. Today's move may look small on the surface, but context changes everything. The reaction at support, the behavior of the dollar, the stabilization in yields, the steady volume. These pieces form a bigger picture. And remember, big trends often restart quietly. If you're serious about understanding these shifts in real time, Silver Shockwave will continue breaking them down without hype, but with clarity. Because in markets like this, clarity is an edge. Now I want you to think about this. If gold starts building higher lows from here, what does that say about confidence in the broader economy? What does it say about currency strength? What does it say about institutional positioning? Sometimes gold isn't just a trade, it's a message. We'll be watching the next resistance level closely. A clean break above it changes the short-term narrative from defensive to offensive. A rejection keeps consolidation intact. Either way, the structure tells the story before the headlines do. As we move into the next sessions, keep your eye on the dollar index, bond yields, and risk sentiment. If they align in gold's favor, momentum can accelerate faster than most expect. Today was not noise, it was information, and in markets, information is power. If you found this breakdown useful, drop a comment below and tell me, do you think gold is preparing for a breakout, or is this just a temporary bounce? I read your comments, and your perspective helps shape future videos. Also share this video with someone who follows the markets but doesn't fully understand what today's move could mean. The more informed we are, the better decisions we make. Stay sharp, stay disciplined, and I'll see you in the next update.